Good evening, everyone. Welcome back to Stock Talk. Welcome back, Eric. This week's topic is SpaceX and its recent IPO. But before we begin, I want to make something very clear. This isn't really a story about SpaceX. It's a story about investor expectations. It's a story about IPO investing and getting caught up in the swirl or excitement of what's hot. I've been managing money for about 35 years. Charles and our investment team, probably close to 40. Between the 5 Oak Harvest investment team members, we've seen a lot of economic and investing cycles in our lifetimes. We've learned one lesson that has probably saved us more money than any valuation model. A great company doesn't automatically make a great stock. These are quite two different things. In fact, many of history's greatest companies have also been terrible investments. If you bought them at the wrong price, say Cisco in 2000, Amazon during parts of the dot-com era, its stock declined around 95% before finding its footing and becoming the company and stock it's become. Tesla, after periods of tremendous enthusiasm, and today, perhaps, SpaceX. This isn't about criticizing innovation or the company. How many jobs has Elon Musk created in his business lifetime versus me? I know that's an easy question to answer. We all know who wins that award. SpaceX might become one of the greatest businesses ever created, and hopefully, public shareholders, it becomes one of the rare multi-decade stock return compounders. Because the question investors should always ask is, am I paying too much for a business? Because in investing, expectations often matter more than excitement. Let's begin with valuation. Less than 2 years ago, private transactions valued SpaceX at less than $350 billion. Less than a year before the IPO, private investors valued it at less than half its IPO value. And just months before the IPO, the merger with xAI established another valuation reference point of roughly $1.25 trillion. Then came the IPO. By agreeing to price the IPO with a predetermined $135 a share, public market investors valued the combined company at $1.77 trillion. And shortly after, when the stock traded over $200 per share for a few days, the market capitalization approached $2.5 trillion. Think about that. The businesses didn't become 5 times better in 18 months. The expectations became 5 times bigger. At roughly $20 billion of annual revenue, investors were paying more than 100 times sales, not earnings, compared to the top 5 or top 10 S&P 500 companies in the market. Hundreds of billions in aggregate lifetime cash flow. Decades of proven profitability, yet investors briefly assigned SpaceX with a top 10 market value. History tells us that while extreme, this isn't unusual. During the dot-com era, many internet companies were valued on what investors hoped they might become, not what they were. Sometimes these companies actually succeeded, but shareholders who paid unrealistic prices often waited years and sometimes decades just to break even. Again, this isn't really a story about SpaceX. It's a story about IPO investing and investor expectations. Looking at SpaceX business itself, SpaceX has 3 major operating engines. The first is Starlink. This is clearly the crown jewel. It generated approximately 61% of company revenue in 2025 and remains the company's primary source of profits and cash flow. The second segment, launch services, rockets, Falcon 9, and next-generation Starship. No one questions SpaceX's leadership in rockets and commercial space business. They literally invented many businesses in this industry. It dominates commercial launches. But many of those launches are supporting Starlink's own satellite network rather than generating incremental third-party revenue yet. The third and final business, artificial intelligence. This is the prospectus that is the newest, least profitable, requires the most CapEx, and is probably 5 to 7 years behind industry leaders. Yes, following the xAI acquisition, SpaceX owns an enormous AI opportunity. The key word here is opportunity. The prospectus calls it TAM, short for Total Addressable Market. But this segment also has enormous AI capital requirements. Today, AI consumes cash much faster than it's producing. Starlink is effectively funding much of the company's broader ambitions, while the newer AI and exploration businesses remain loss-making. xAI is losing so much money investing in its TAM that SpaceX has already borrowed tens of billions of dollars to fund expansion. This is where investing becomes difficult. Revenue can grow, the story can improve, The technology can be revolutionary, but if billions of dollars must continually be reinvested, with free cash flow remaining under pressure for established players like, say, Google, Microsoft, Meta, and Amazon, and massively negative multi-year funding deficit for the likes of SpaceX, well, eventually investors stop asking, how fast is the company growing? And they begin asking, when do shareholders actually receive cash? When do we reach that Jerry Maguire moment? Show me the money! When does the company show me the money? The third lesson has very little to do with rockets. For those not around during dot-com bubble, it's probably a new lesson to learn. It has everything to do with market structure. It has everything to do with Wall Street, bankers, and value maximization for the company. Following the IPO, only 4 to 5% of SpaceX shares were available for public trading. Think about that. This means that 95% of the company's shares weren't available to buy or sell. When supply is initially limited, it doesn't take much buying to create enormous price moves. Couple this with the fact that there are special index rules changes made in some large indexes to create billions of dollars of mechanical buying by passive funds and ETFs shortly after the IPO, independent of the company's underlying fundamentals. The last time I heard of this level of restriction in an IPO was way back when, at the end of the dot-com, with a little company back then known as Webvan. Yes, investors, the original public home delivery grocery service wasn't Instacart, but it was rather another restricted float IPO almost 30 years ago. It went out of business just a few years later. Okay, investors, so history teaches us a great lesson. Low float doesn't last forever. Employees eventually receive unlocked shares, early venture investors gain liquidity, insiders gradually sell. SpaceX has adopted a staggered lockup schedule extending over the coming year, increasing the effective public float over time. Yes, they are trying to smooth the process, but we've seen this movie before. As I said, during the dot-com boom, small public floats often created spectacular early rallies. Pets.com, amongst other shooting stars, but eventually more shares became available. The excitement fades, fundamentals take over again. Again, this isn't really a video about SpaceX. It's a story about investor expectations and IPO investing. Every investment deserves two separate questions. Question number one, is this a great business? How much cash is required to generate a cash return? SpaceX may very well become one of the greatest businesses of the next generation. Time will tell. Remember, it took Amazon nearly 10 years as a public company for its stock to catch up to its IPO expectations. The company went public in 1997, had a huge run into dot-com top, declined 95% as they invested for the future, but the economy went into a recession and the stock never exceeded its dot-com high until the late 2009, almost exactly 10 years to the month after its dot-com peak. 10 years, not quarters or months, and of course, this has become one of the biggest secular growth stories in the last 40 years. Question number two, am I paying a reasonable price? That's where investing becomes difficult. The best investors learn to admire a company without falling in love with its stock. History has a remarkable way of repeating itself. The names change, the technology changes, the excitement changes, but investor psychology rarely does. During the dot-com era, people believed the internet would change the world. In fact, it did. Many investors still lost money. Tesla transformed the automobile industry, but early buyers at the wrong valuation still endured years of volatility. Now, SpaceX may transform communications, space exploration, and artificial intelligence. It may ultimately justify much of today's optimism, or it may not. Time will tell. But regardless of the outcome, the investing lesson remains the same. This isn't really a story about SpaceX. It's a story about investor expectations. Because after 35 years in this business, I've learned that investors don't lose money simply because they buy bad companies. Most often, they lose money because they pay the wrong prices for extraordinary stories at the wrong time. I've done it. Charles has done it. Almost everyone who's invested publicly has done it. The best investors stay disciplined. Our team decided to pass on the SpaceX IPO because it didn't exhibit the characteristics our investment methodology looks for at the time of the deal. We chose to separate admiration from valuation on this one at this time. This isn't to say that one day SpaceX won't exhibit the things our team is looking for our clients, and if the price is right, we might make it a holding here at the firm. But please remember, there can be a big difference between a great business and a great investment. I'm Chris Perras. Thank you for watching, and we'll see you next week.